You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. I don't know about you listeners, but that rocking indeed, that very martial theme really puts me in the mood to do some options educating. My name is Mark Longo from theoptionsinsider.com, as well as from the Options Insider Radio Network. And before I dive into the show proper, let me just remind all of you guys out there, if you haven't checked it out yet, surf on over to your app store of choice, Google Play App Store, iTunes App Store, or even the Amazon Kindle Fire App Store, and take a look at our Options Insider Radio Network app. I think you're going to like it. Of course, you can subscribe to this program in it, Options Bootcamp, as well as all of the many other varied and fun programs on the Options Insider Radio Network. You can take your pick. You want to learn about futures options. You want to learn about technology in the options space. If you are a financial advisor and you want more information, you take your pick. If you want more daily news and you're not sick of Dan Passarelli, you can check out that show. A lot of good stuff cooking on the old Options Insider Radio Network. Check it out. Look for the Options Insider Radio Network mobile app in your app store of choice. All right, and joining me on the old Bootcamp drill instructor squad today, starting off with the man who kind of didn't have a voice for the last few episodes, but he's finally back in full form and fine fashion. None other than Mr. John Critchley, the options major domo over there at sogotrade.com. John, welcome back to the program, sir.
Hi, folks. Good afternoon to all. We are waiting some global warming in New York coming in the next few days after a record 100-year record snowfall. So I just can't wait for some nice and toasty 40-degree weather. Looking forward to it.
Yeah, it's about 50, 60 degrees warmer than it was just a week or so ago. But it's nice to hear you back in fine form there, John. Your last few episodes, I know you were struggling to keep up, and now I think you can just run the whole show. Dan and I can just hop right off. What do you think?
Yeah, I don't think Dan would like that. So.
No, I feel much better when John's around.
There you go. He keeps me in check.
I get uncomfortable when I'm alone with Mark.
Yes, as we've proven that many a time. Mr., of course, listeners, you may recognize that voice, none other than Mr. Dan Passarelli from Market Taker Mentoring, as well as the MTM Elite community. Don't even think of signing up if you're not elite. You can just go elsewhere for one of those subpar trader chat rooms. But if you're really elite, then check out the MTM Elite community. Mr. Passarelli, welcome back to the show, sir.
It is splendid to be back, Mark. Thank you very much.
I never checked. Am I elite enough to join your elite community? I don't know. Am I, or do I have to perform to some standard?
No, I'm sorry. You're actually not elite enough. John is, Mike is, but I don't know. Come back next year.
I kind of thought as much. You guys are kind of snobby over there at the MTM Elite. I'm just going to say. You put that elite in the title, and all of a sudden it's like the Ivy League, 0.01% acceptance rate and all that fun stuff. All right. And you mentioned Mike. That is, of course, Uncle Mike Tusaw of Option Block fame. He will be joining us for a record, actually, second appearance here on the Options Bootcamp program. He'll be joining us a little bit later as we dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, print bear to learn. Yes, sir.
All right, everybody, welcome to the basic training segment. As the name implies, this is, of course, a portion of the show where we take some basic options concept and we break it down for you, and then we tell you how you can implement it into your own options and indeed your own trading portfolio. And we say basic today, but we're actually moving a little bit beyond that today, getting a little bit more of the intermediate, or dare I say advanced territory with what we're talking about today. If you remember on our last episode, we dove into the very, very murky waters of adjustments. It's kind of a scary topic because it's very broad and very vast and very intricate, and it changes from one person to another on how they adjust based on their own risk aversion and how they manage their portfolios and things like that. So it's a very interesting and very complicated and very intricate topic, and we kind of scratched the surface last episode. If you really want to get into the basics of options adjustments, I encourage you to go check that out. Really quick, Mr. Passarelli, do a favor for our listeners who maybe haven't listened to the last one in a while or are just tuning in now. Really, really quick, basic overview of what are options adjustments and why you want to do them.
Well, adjustments, like the name implies, is you're changing positions somewhat. And, we talked about this a little bit last week, so make sure you guys go back and review the previous boot camp. But an adjustment can be anything from something very, very simple, like I think technically I'd call closing a position an adjustment, or closing part of a position, to something very, very complicated potentially too, where you add legs to a trade, or you do something called rolling, where you change strikes. Any change to an existing position is an adjustment.
Thank you for that. Unusually succinct, sir. So well done. I like it. You're learning from being on this program for quite a while. But yes, so we hit on the basic kind of single leg adjustments. We touched on a few spread type positions like the covered call, which is essentially underlying in one leg of an option trade, and when you should maybe think about adjusting that. But we didn't really get into the mother lode of adjustments. That's, of course, spreads. And spreads are really where the rubber meets the road, both from an options trading perspective and also from an options adjustment perspective. If you're putting on spreads and you don't really know how to adjust them in an appropriate fashion, it could really be detrimental down the road for your trading performance. You could easily put on a great position and then proceed to really screw it up by some bad adjustments, or vice versa. You could put on a position that maybe wasn't the most well thought out position to begin with, but you might be able to salvage it with a few well-placed and well-timed adjustments. So we're going to walk through some of that today, getting into the spread portion of the adjustment equation. So in general, there's a bunch of different rules of thumb. People are always writing in, what's your rule of thumb for this? What's your rule of thumb for that? And we've talked about spreads on the show in the past. Again, check out the basic and advanced spreads episodes if you want more information on spreads in general. But we touched on it there in spreads when it comes to performance. It also kind of applies to adjustments as well when you're thinking about the performance of a spread. In general, when you're looking at spreads, most spreads, basic spreads anyway, really tend to perform at their maximum when they're at the short strike in whatever type of spread you're putting on. So if you have a basic vertical, obviously, you're buying a call vertical, it rallies to that short strike of it, or even goes through, you've made your maximum profit. If you're doing some other spreads, short premium type spreads, let's say an iron fly where you're selling the guts and buying the wings, you want it to sit there right there, that short strike in the middle, and decay to zero. That's where you get your max profit on that spread. So in the vast majority of spreads, obviously there are exceptions to every rule. You can put on all sorts of crazy multi-legged things that really don't adhere to any rules of thumb. But in general, when you're thinking about your spread and looking at it on the surface of it, you think, how is this going to perform? In general, if your spread and the underlying kind of moves to the short strike, you're usually doing pretty good. In some scenarios, though, if you're depending on how you're doing it, if you're doing a levered ratio, let's say, for example, 1/2, 1/3, then you want to get a little careful when you get on that short strike, too, because that's, of course, when you start getting past it, that's when you start getting into danger. But let's start off really at the basics. Probably the most basic spread is typically the typical vertical call spread or the vertical put spread. Usually you're buying an at-the-money, maybe somewhat in-the-money option, selling a farther out-the-money option against it. You typically want the underlying to move in whatever direction you're looking at. If you're looking at calls, obviously you're bullish. If you're buying the spread, I'm talking about long spreads now. You want the underlying to rally to that short strike, and the put spread, vice versa. You want it to drop to that short strike to make the maximum profit on that spread. It's a very basic position, and it's kind of, in many ways, the thought process that you would have in terms of adjustment on that would be in many ways analogous to if you just had the outright long position around the at-the-money strike, because that is really where the meat of that position lies, and that's where a lot of your adjustment strategy is going to take place on that spread in particular. And joining us today to help us find our way through the land of spread adjustments, none other than Mr. Uncle Mike Tusaw of Option Block fame and also from RCM Wealth Advisors. Uncle Mike, welcome to the Options Bootcamp program for the second episode in a row, sir.
Always a pleasure to be here, and I'm honored to be here for a second straight week.
And hopefully the Skype gods will keep smiling on you throughout this episode. It is a nice sunny day here in Chicago, so the beam in from St. Charles shouldn't be too bad. But Uncle Mike, we're in the midst of discussing vertical spreads. I know you guys like to employ these quite a bit over there at RCM. It's kind of the most basic spread strategy you can employ. What's your general strategy? What's your general scenario for adjusting in your basic, typical vertical spread, long call spread, long put spread, that sort of thing?
Well, to give you an idea, let's say that we're going a long vertical alone, just a long vertical. If we're combining it with another trade, then throw out what I'm about to say. But let's say we're just doing a XYZs at 50, we sell a 45-40 bull put spread. Typical MO of what we like to look for is if an option has, the short leg of the option has around between a 7 to 10 delta on it, or negative delta or positive delta, depending if it's a call or put. And what we look at is when that short option gets to a 25 delta, that's when it's our cue to either get out of the trade, possibly roll down the spread in some way, shape, or form, or put in some type of hedge in one way, shape, or form. To the downside, typically with the put, I wouldn't have a problem with rolling it. To the upside, if it's a call spread, usually I end up just getting out. But with it, we like to prevent a blowout before a blowout happens, if that makes sense. When the short option goes from 7 to 25 in delta, what that does is that creates about a loss similar to the credit that you took in most of the time. Not all the time, but a lot of times it does. And the benefit of that is that if you're just losing what you were trying to get a credit of, then you have the ability to live to trade another day. If you actually wait until it touches the short strike price, or if it goes in the money a little bit, then what's going to happen, and we've talked about this in the past, is that if you're right on the borderline, let's say I wait till the stock goes down to 45, if I'm right on the borderline, and then all of a sudden overnight we have a gap down to 38, I'm toast. I'm done for the year. And we try and make it so that you're not done for the year. If you're at that stage, then you need to be out before you're in that bad situation. So most of the time in the example I gave, if the stock's at 50 and we're short the 45-40 bull put spread, we're usually out or adjusted down or something along those lines when it's at, and I'll just throw out a random number, around the 48 level for the stock itself. So that way you avoid getting those once-a-year losses that screw up your whole 3-year trading plan. So it's just kind of like the old double chicken wing analogy I gave last time. What's the best way to get out of it? Don't get into it in the first place.
All right. Thank you, Uncle Mike. Listeners, you may have noticed the Skype god's not exactly complying with good old Uncle Mike, but we'd rather keep him on than not have him on the old episode. So we'll do our best to make it sound good for you. Hopefully the Skype connection is working a little better out in scenic Frankfurt Illinois, where we are joined by none other than Mr. Dan Passarelli. Dan, I know you spend a lot of your time with your clients, particularly a lot of your basic clients, probably walking them through these exact scenarios. They come to you, they say, Dan, I've got a long vertical on, and now the underlying's maybe moved halfway up my strike differential. What the heck do I do with this? So what's your typical adjustment scenario for your basic long vertical call spread, or even, dare I say it, put spread, sir?
Well, the main technique that we teach at Market Taker is, I guess it's kind of like Mike was saying about, don't get into it, is that the best way to get us to not get into it? All the adjustments are always extensions of what you initially did, You put on a trade for this reason, and then there's an adjustment which is related to how you put on the trade in the first place. And when we trade credit spreads, I always tell my students, look, when you put on a credit spread, you should plan your short strike around support and resistance. So, for example, if it's a call credit spread, you sell a call above resistance, at or above resistance, preferably above. If it's a put credit spread, you sell the short strike at or below support. So for me, the adjustment comes into play once the support or resistance line is permeated. Once that happens, you kind of have to do something because, resistance holds until it doesn't, and then resistance can become support, and the trend can really go against you once one of those two levels, support or resistance, is permeated. So, that's kind of how we view the universe, and I think I think it's a pretty good disciplined approach, especially for a new trader.
Yeah, it kind of builds that adjustment strategy in at the beginning, which we've talked about many times on this show. Have that strategy going in so it doesn't hit you, oh no, what do I do now? That's the one thing we like to preach, perhaps more than anything here on the show, is be prepared. Sounds kind of cliche, sounds kind of trite, but you'd be surprised how effective that could be. All right, moving on from the basic vertical, some great strategies, some great ideas for adjusting there. I think Delta is a great way to do it in your head when you're adjusting those verticals, when you're considering making adjustments. Moving on to probably one of the next most common basic entry points for a lot of retail clients, particularly because a lot of them get pitched this by so many, shall we say, less than reputable educational outlets who say, come on in and make money in any market condition using options. Of course, I'm talking about straddle, in particular the long straddle. We'll talk about short straddles a little bit too, but the long straddle, of course, a very simple position that combines a long call and a long put on the same strike. So by the very, very pure definition aspect of it, it does indeed make money in any market condition, at least in terms of where the underlying moves. But the truth is, and the reason we've counseled against him really here on the show, is that the key to making straddles work, particularly long straddles, is the adjustments, is what you really need to do. As a professional options trader, our typical strategy approach, something like this, would be to gamma scalp. We'd take advantage of all that long gamma, all those Greeks you're getting from buying that straddle, and you would sell stock at a high level, take advantage of your long deltas, buy it back at a lower level, take advantage of those short deltas, and scalp stock back and forth. That's a difficult thing for retail to do for a number of reasons. Margin, all count size, all these types of things that are difficult to do. So there's other ways you really have to adjust when you're looking at long straddles. I think the first way that a lot of people look at when looking at a basic long straddle is it's like any other long at-the-money option position. They buy a straddle and they think, well, okay, I just need it to run in one direction. I don't care which way it goes. I just need it to go somewhere. It can't sit here. That's obviously the kiss of death for an option, for a straddle, because you're long two options as opposed to one of the same strike. So you're getting all that fun decay times two. So you need it to move. So the first part of that is looking at that like you would any other at-the-money option and doing what we outlined before on the previous episode, or Mike just outlined now, looking at your deltas, having some sort of plan for, I get to this delta, this premium level, I'm going to sell this option, and then perhaps hope for a retracement and hope for it to come back and maybe close out the second leg of it or take another approach to it. The second portion is perhaps a little bit more intriguing and a little bit more complex. It's just that you actually use it to leg into simple verticals. So the underlying runs, and now you have these two at-the-money options you've bought, and then you proceed to sell farther out-of-the-money option against that at-the-money option, hoping to leg into a spread for some sort of decent level. Of course, still on that point, you have to need some significant movement in the underlying to really have that spread-type strategy pay off. Those are two of the most basic adjustment-type trades we see people doing against a long straddle. John, what's your approach when you're looking at a long straddle or when a client calls you up over there at Sogo Trade, says, hey, Mr. Critchley, Mr. Options Major Domo, I have a long straddle. What do I do? What do you typically say to them?
Well, the one thing I want to hit on was Mark's 100% right. The long straddle, I wouldn't say it's really only for pros because it's not that complicated a straddle. But if you can't gamma scalp around it, it's tricky for a lot of retail customers. When I look to adjust, or put a spread on, my first objective, of course, is, I want to lock in a profit while still retaining some upside profit potential. We spoke about that in the last show. When I have a straddle and I put a straddle on, and let's say it goes on the upside in my favor, there's a few things the customer can do. First they can let it ride. I don't necessarily agree with that. If you're a gambler, let it ride. But again, if you have the straddle and it's going higher, you can buy another put to lock in profit. You're gonna retain unlimited profit potential on the upside, and now you have some greater profit potential on the downside. The con there is that you're putting up more capital to buy the puts. You can also, if the straddle is going in your favor, you can also adjust by selling the call to lock in a profit. Either the long call either selling the call that you're long or a different call. So you can do that. There are many different ways to adjust. And what I try to tell customers is that, have an objective, have a game plan, and I know we've talked about this in the past, have an exit strategy for adjustments, so to speak. Just don't go in there and willy-nilly, adjust. Just have a plan in place. And Mike, hit on it great with those numbers that they use when they teach a certain percentage or a certain delta. That's a great way to look at it.
Interesting. So you would actually leg into a long put stupid if your underlying rally that way, or vice versa. I suppose a long call stupid if you were going the other way, in order to try to trade that straddle. That's interesting.
Love the stupid.
I knew that would perk your ears up, Uncle Mike. Of course, you guys don't trade a lot of long straddles over there, but you do a lot of a hedging of different types of long gamma and long vega type positions. So the analogy is somewhat similar. And I know you guys also do trade some short premium positions once in a while, although we won't say that out too loud. So, Uncle Mike, what's your strategy for, in general, these long straddle type positions and these similar type things when you're hedging them? And then maybe let's flip it to the dark side a little bit and look at the short side as well.
On the long straddle side of it, man, I couldn't even tell you the last time I did a long straddle without some type of short premium sold against it. It's one of those trades you just have to sit and wait for something to happen. And I seriously couldn't even tell you the last time I did just a straight long straddle. I've done if I'm ever to do something where I'm expecting a lot of movement one way or another, I usually lean slightly bullish or slightly bearish, and I'll set it up as like a back spread or something along those lines. And then we talked about that a little bit in the last episode. But on the dark side, Kavanaugh and I, the founder of RCM, we actually had a strategy that we used a couple years ago, and it got too time intensive, but it still has a lot of valor to it, in our opinion. It's called the leapfrog. And so what we did is we would actually we used the S&P E-mini, and it was one that we would sell at the money front month straddle. So let's say we took in 50 points for it. So the basic gist of it was that so long as the S&P wouldn't move 50 points, then we'd be profitable for the month. We would actually get out of it and I'd have to go back to my archives to see what our profit target was, but we would get out of it whenever we would actually have like maybe a 5 or a 10-point profit due to time decay. Because remember, if the market stays the same, there is no better place to be than right at the money. Problem is the market doesn't stay the same all the time. So whenever we had a still market, it would work great. So the question then becomes, what do we do if the market does not stay still? We would have extra money on the sidelines. So if the market were to move 50 points to the upside or the downside, what we would then do is sell another straddle. So let's say the market were to move 50 points, it gets to the edge of our adjustment point, we'd sell another at-the-money straddle. So at that stage, we have 2 straddles on the table. And we have a wider range that the market can move, and we can still collect that premium. Now, let's say the market goes even another 50 points in the same direction. So we have 100 points of movement in the same direction. We take the original straddle, get out of that, sell another straddle at the money, and we do what's called the leapfrog technique. So on there, we did it, and we actually had some success doing this. And then Kavanaugh, I have to give credit to Kavanaugh. This is his strategy. He did it with the SPX even in the days of of 08, and actually came out profitable on this for one client. That's when he kind of experimented and invented this strategy. But the concept then is that the market continues to move, then you're going to have to get out for a loss. But with it, if I'm on the dark side and selling premium, you're naked, you have to have a lot of money on the sidelines. So to give you an idea of the dollar amounts with which we did this, we had a client doing a one lot on the SPX, and this is back when the SPX was around 1,200, and we would do a one lot on the SPX, and the account size or the amount allocated for this was about 120,000. So it's naked, but it's really not leveraged that much, and we came out ahead on it. So in terms of ways with which to adjust on a short straddle, I think the main thing with which you need to do on both a short straddle or any short naked option of any kind is to have money on the sidelines ready to do things like that.
Yeah, that's kind of a good rule of thumb, a good thing to live by trading. In fact, we have a listener question, I believe, about that exact topic, so maybe we'll table that for a little bit. But you're right, it is important to have some bullets in the old holster in case you need to make some adjustments, because otherwise, if what we're talking about here and you're maxed out on your account, then all these adjustments all this stuff we're talking about here is kind of just out the window. But yeah, the long straddle, it's a weird beast. The short straddle, also a weird beast for other reasons. One of the reasons why we don't really get into those that often here on this show, Mike doesn't really trade them. Most of us really here don't trade them, and we don't really counsel our my case, listeners, but in their case, clients or what have you, to really, trade these. We typically tend to prefer the spreads that take advantage of the actual spreading, which is the wings, and these have wing components. So instead of seeing us putting on an outright long or short straddle, you're probably going to see one of us putting on something with a little bit more wings to it. And again, if you want more familiarity, refreshment on these quote-unquote advanced spreads, a.k.a. the spreads with wings, check out our advanced spreads episode here of Options Bootcamp. We walk through all these various scenarios. But for a scenario like that where you're looking at a long straddle and you're thinking, well, gee, the underlying runs, what am I going to do with this? And should I sell this out and hope for the retracement? You can take care of a lot of that by setting it up ahead of time with actual wings. So instead of just buying that at the money straddle, now you turn it into, let's say, a butterfly, or one of my favorites, an iron butterfly. So you're selling a wings, an out of the money call, and out of the money put against it. Why would you do that? Well, all the reasons we outlined on that spread episode, reducing your premium outlay. It's kind of setting in some fixed positions at the outset so you know exactly what you have on. You have these verticals on in both directions, so you have a little bit more fixed, reduced risk up front. So it's a better way to trade overall. And of course, the other types of butterflies, and we can get into condors in a little bit. We'll start off with the flies, though, because those are probably very attractive, I know, for a lot of you out there. In fact, I think our initial listener wrote in asking about short legs on flies and condors and things like that. So, Mr. Passarelli, when you're graduating your students up to the butterfly level, what are some of the typical adjustment scenarios you would walk through there? Maybe we'll start on the light side, a.k.a. the long fly type side, and then we'll get into some of the darker side type fly adjustments.
Yeah, I mean, one of the most typical and easiest adjustments to a butterfly, or even just a credit spread, is what I call the butterfly adjustment, cleverly enough.
You have a flair for branding, sir.
Yes. And so basically what that is imagine just a straight long call butterfly. So that is a call debit spread with a call credit spread where the short strike overlaps. So now imagine that the stock has begun to rise too much, and it looks like you might bust through your break even on your profit and loss diagram, and you've got to do something. You got to fix it. So what I champion is going out and buying a whole new butterfly on top of it. And what you end up doing is the credit spread side of the butterfly, you buy a debit spread to cancel that out and open up a new credit spread. And so basically it's kind of hard. It would be nice if we had a visual aid. This is radio. I guess that we don't get visual aids, do we?
Not in this medium, sir. No, you have to use your words.
Yes. I've been told I have a face for radio.
It's like your kindergarten teacher used to say, use your words.
Yeah. Imagine that we have a butterfly. It's, say, the 45, 50, 55 call butterfly. So we're long one of the 45 calls, short two of the 50 calls, long one of the 55 calls. The stock has risen too much. We need to adjust. Here's what we do. We buy the 50, 55, 60 call butterfly. So what that does is it closes one of the short 50 calls, and it closes the long 55 call, and then it opens up a new long 55 call, and a new short 55 call, and opens up a new long 60 call. So effectively, by just buying one more butterfly, what you do is you roll your butterfly into a condor. So it gives you a little bit more wiggle room to the upside, and it's just one fell swoop trade that takes off the position that's given you problems and opens up a new one that gives you a better fighting chance of making money on the position.
So this is for a scenario where the underlying is just moving aggressively and kind of blowing out your previous trade, and you want to kind of just reestablish.
Exactly.
So there you go. Well, that's an interesting scenario, actually. I guess that's why I say adjustments are kind of this dark art in voodoo, because everyone's got a different way of doing it. It's kind of interesting to hear, that approach. That's actually one of the specific questions someone asked. What do you do when the price hits the short strike in a condor credit spread or the wings of a butterfly? Typically, it's actually a good thing, like I mentioned earlier in the rules of thumb for spreads. But depending on what the spread you have on and how aggressively that underlying is moving and how fast and how far, perhaps beyond that strike, it is moving, it could become a bad thing very quickly. So in that scenario, taking that off and then indeed flipping the script with an additional butterfly and kind of transforming it into a condor may be an interesting way to keep yourself in the game and adjust a little bit. Again, people are sometimes leery to put on adjustments that are going to end up costing them some sort of outlay. But again, that's what Mike was talking about earlier. That's what we said here on the show. Keep a little reserve in your account for these types of scenarios, because anything you put on at the beginning of the day is going to evolve when it comes into contact with the marketplace, and you need to have the capital there to really use that sort of adjustment. Now, the other side of the flies, perhaps the most popular winged type trade that we see, certainly from a newsletter perspective, certainly from an educational perspective. Ever since we launched Insiders, that's been 7 years now, I've seen just everyone and their mother seems to be diving into this one particular strategy and hawking it as part of their wares. It is, of course, the Iron Condor. If you want to learn more about that one, again, check out our Spreads with Wings, our advanced spreads segment here, or go search for it on Options Insider. We have a bunch of great information on that. And now, Mr. Passarella, you just mentioned kind of legging in your butterfly into an Iron Condor type strategy. Would you take a similar type adjustment approach for your Iron Condor, or do you tweak it a little bit differently?
Yeah, I mean, the elegance of the butterfly adjustment is that it can be used not just on butterflies, it can be used on Iron Condors and any credit spread, because really all it is it's really what it's always used for is credit spreads, but it's the credit spread components of a butterfly or of an Iron Condor. So it's just so simple. All it does is it rolls up a credit spread one strike by putting on one simple trade. And a lot of times with spreads, especially multi-leg spreads, it makes it easier to middle the market, so you give less up to slippage doing it that way, and it's just a really super practical technique.
That's a good point. We were mentioning these for some of these more elaborate type spread scenarios like Iron Flies and Iron Condors and things, but as Dan just mentioned, these same types of methodologies can apply to simpler spreads, any sort of basic credit type spread or debit type spread. At the end of the day, that's what these Iron Condors and flies and different positions really are. At the end of the day, you're either collecting a credit or you're paying out a debit, and you adjust accordingly. So you can take these similar approaches, even if your spread isn't as complicated. It's a simple two-legged credit spread, and go from there. I know some people will take issue with the fact that I use the term credit spread. We'll save that for another episode. Uncle Mike Tusa, I know you guys do a lot in that realm of not so much on the flies, but definitely on the credit spread side. And also, maybe once in a while, you might leg into an iron condor. I know you love the stupid. We're not going to talk about adjusting stupids here, but iron condors and or the occasional credit spread. What's your methodology? You do something similar to Dan? Would you say put on another of the same spread and kind of morph it into something else if it's running against you? Or what's your typical adjustment strategy in those scenarios?
Well, typically to the upside, I've tried I've done a few things in the past in terms of, like, I think I've even read online the Mighty Mouse adjustment, the 1 for 10 adjustment, where let's say that the call spread is going against you, the market's running up, and then maybe for every 10 spreads you have on, you buy one call option to hedge it in case the market goes higher. But to the upside, every time I try and do something like that, it just seems to me that the market goes right back down the second I try and adjust it, and then I just created 2 losing trades instead of 1. So typically to the upside, what I like to do is either one, start with some positive deltas in general, not because I'm necessarily bullish, but because of the fact that if the market goes down, I sometimes have volatility working in my favor to an extent, with being able to roll puts out, which I'll talk about in a second. But number 2, just because rolling to the upside is just kind of a difficult thing for a lot of the things that I do. So most of the time what I want to do is either just get out, admit I'm wrong, and move on, or have something to where I'm a little bit bullish in the first place. Now, to the downside, that's where if you can get some higher volatility as the market goes downward, you can do some to me, it's always easier to roll a losing short put position or to adjust a losing short put position than a losing short call position. You have more volatility as the market goes down. There's more juice. You have more choices of different spots with which to roll. There's more spreads available. And so to the downside, a lot of times what I'll do is maybe buy to close the short put spread and maybe sell another one a little bit further out for a little bit of a debit, and then just maybe hang on until the market, till that one expires, something along those lines, or maybe go out another month and then maybe close the short call spread for a profit, something along those lines. But to the upside, it's adjusting losing positions on the short call side is not my forte. It's not something that I'm able to do very effectively, and I don't choose to do it very effectively because it's just not what I want to do effectively, quite frankly. But to the downside, there's a lot of things to do, and it's a lot easier to roll a losing short put position or put spread in general, in my opinion.
That's true. You do have more options, pun intended, when you're looking to the dark side than to the light side. Mr. Critchley, this is a perfect example of why we could spend probably 10 episodes talking about this stuff, because there's so many different nuances for adjusting each different type of spread. Where we're kind of blowing through them really quick, listeners, give you kind of an overview. If you have specific questions, of course, write in. We'll dive into them again on future shows. But, John, looking at it just from the pure credit spread angle, what's your take on those types of adjustments, and what do you tend to favor over other types of adjustments in different scenarios?
Well, the one thing that I think we mentioned last week, and I want to mention again maybe, is that, part of my personal bias, and also because I'm trying to protect the firm, we don't discourage short selling if you have the money. But if a customer comes to me and says, I want to sell premium, I want to get short, well, what do I do? And, if you talk to Dan and Mark and Mike and the pros, they're going to tell you credit spreads. So if I recommend a credit spread, like I say, a put credit spread, and it goes awry, it goes against the customers, what do you tell them to do? Well, the one thing you can do is you can sell a call spread then. So if you sell the 110, 100 put spread and it's going against you, and now this underline's at 100 or 102, now maybe you can sell the 90, 100 call spread. So that's one thing that you're basically taking the opposite side of the trade. Now, of course, there's a disadvantage there that you really create a tight window of profit for yourself, and now you have risk in two different directions. But it's a way to kind of to whittle the position down and to maybe to adjust a little bit, and that enables us to tell a customer, you can keep doing these credit spreads, and if you need to adjust, try doing this. I haven't. There's no name for this trade. I haven't named it yet, but I think it's actually pretty darn good trade for a customer, and a kind of different way to look at adjusting is actually taking the opposite side of the trade.
John, for you, and this goes for all of you guys who are thinking about naming your different strategies, I I often like to go with the Longo strategy or sometimes the Mark Longo effective trading strategy. Whatever floats your boat in that genre, I find it all is very effective and it works quite well from a naming and a branding. I'm just throwing it out there for you guys, something to mull over. But all right, getting back into the serious realm again, we could go on to the stuff for quite a while, but we have to keep on rolling into some other types of strategies. And I couldn't really close out the adjustment part 2 portion of the discussion without at least touching on perhaps our most controversial subject on this show. We got more mail, more letters on this one than pretty much anything else. And that was, of course, our calendar spread, our time spread segment. The adjustments here are kind of analogous to what we were just talking about before with some of the basic credit spread type adjustments and debit spread type adjustments we were talking about before. But obviously, it changed a little bit in flavor because we're going out in time now. We'll keep it relatively straightforward for the purposes of this discussion. Maybe we can always dive into it again down the road. But Dan, let's walk our listeners through an adjustment here of your very, very basic 1 month simple horizontal calendar spread. Let's say you're long the 1 month out, short the front month, or vice versa. Walk us through some typical adjustment strategies you would usually employ for that very, very basic strategy.
Well, back to the original comment that I made that an adjustment is just changing a position in any way. We can address it as adjustments for situations where you're profitable or situations where you're losing money. One of my favorite adjustments, probably one of my favorites because you do it when you're making money and it's a way to make more money, is when you have on a time spread and you roll to the next month. So imagine that I buy, say, the September, March time spread in some stock, doesn't matter what the strike is. And then the time spread works out just perfectly. The stock is right at the strike price at expiration when March rolls along. And I think the stock is still going to stay in a range. I want to continue my time spread, but goodness, March is expiring. What do I do? Simple. All I do is I sell the March-April call time spread. So I'm basically adding another time spread to roll my time spread, much like we do with the butterfly roll. So how that would work is, say I'm long the September 50 calls and I'm short the March 50 calls. When I get to March expiration, what I do is I sell April 50 calls and buy the March 50 calls. So I'm selling that time spread, selling the longer term April one and buying the March. What that does is it closes out my March and it opens a brand new position in the April. Now, one of the items of pushback, I guess, if you will, that I get from novice students is they say, well, why don't I just wait until the March expires? I don't need to do the roll. Then I end up paying extra commissions. Well, that's all fine and good. Don't get me wrong. I don't like paying commissions I don't have to, but that is one I have to. That's one where you're way better off paying that commission, because if you wait until it expires, what happens is you're naked long the September calls until Monday when the March comes off and you have the opportunity to sell the April. So you have gap risk. You go from a neutral trade to a directional trade. So always do that roll if you want to continue the time spread on. If you still like the time spread and you want to, move on to the next month and keep it going, always do the roll. Don't wait until it expires.
All right, thank you for that, Senior Passarelli. And like I said, I think we could go on with these for quite a while. Somehow I have the feeling we'll be revisiting adjustments down the road. Again, this is just kind of scratching the surface. There's so many different ways and different specific scenarios you may want to adjust in different ways. Couldn't possibly fit them all into a 1 hour show, particularly if I want to make sure you guys have your chance to be featured on the program. So without further ado, let's dive right on into the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, that music means it is time once again for the mail call, my personal favorite portion of the show. Don't tell these guys, they'll be offended deeply, but this is really my favorite part of the show because it gives you guys a chance to join us here on the old Options Bootcamp Drill Instructor Squad. If you'd like to make your voices heard on the segment, a lot of great ways to do that. Of course, surf on over to theoptionsinsider.com. Leave a comment on this episode show notes or any other episode of Options Bootcamp. We'll route it to this program. Shoot us an email, questions@theoptionsinsider.com. Find us on Twitter or Facebook, twitter.com/options, facebook.com/theoptionsinsider, or even hit us up through our new mobile app. You can do it right there in the tabs. A lot of great ways to find us and make your voices heard here on the old mail call segment. The first question here in today's mail call comes from a physician. We have a physician in the audience. Question from Dr. Anthony. He writes, I enjoyed your episode on the wheel trade. I would like to know more about your typical use case for wheel trades, particularly when it comes to the second leg. Do you write an in-the-money or at-the-money call, hoping for the stock to be called away quickly, thereby allowing you to begin the process again, or do you prefer to write an out-of-the-money call and attempt to capture some appreciation in the underlying while risking losses in the stock? Again, he is referring listeners to episode 38, where we talked about the wheel trade, a.k.a. I know you guys at RCM might call it the triple income strategy. I know this is one of your favorites, so I think it's opportune you're actually on the show to talk about this. I think actually your friend Mr. Kavanaugh over there refers to it as the wheel of fun. It's a strategy you guys are very familiar with. So since you're the guest today, I'll give you pride of place. Walk us through your typical use case for a wheel. And like Dr. Anthony asked, do you write at the money really aggressively? Do you write a little bit more out of the money, a little bit more conservatively? What's your typical strategy for using a wheel?
Well, sometimes it's fun. Sometimes it's the wheel of not so much fun. You never know, basically. But I would say, a lot of times when we'll do it, one of two ways. And I'm going to give it a little added twist today, just for our listening, just for the Option Bootcamp audience alone. Step one, we'll sell a put. XYZ stocks, we'll use 50 again, and we want to get in at 45. And then the concept would be to we're more than happy to own the stock at 45, so we sell a 45 put. If the stock goes down to 45, hey, we're happy to own it at that level anyway. But if for some reason that it doesn't get there, then we get basically a dividend for waiting, for lack of a better term. From there, what we then want to do is if we don't get the stock put to us, we just let it expire worthless, or a lot of times when we can collect 80% of the time decay, we'll just get out. So if we got $1 credit for it, if we can get out for 20 cents, then we'll get out for 20 cents. And at that stage, we'll just move on and start the process over again. Let's say we get the stock put to us. Well, at that stage, what we then do is like to sell a covered call, typically at the money if possible. So we like to start out of the money, meaning below the strike price, and then once we get in, we're going to have a little bit more volatility typically. We'll sell some premium at the money. And then if we get called away at the same strike price we got in at, then we had some nice premium for a couple months. We'll start over again. At that stage, what we then have to do if the stock does get put to us is that we need to come up with a risk management plan. Should we get out of the stock if it goes down to, say, 38, 42, 44, whatever the case may be? Or do we stay in it? Are we bullish? What do we do? Sometimes, let's say the stock continues to go down, because if the put expires worthless, or if we get called away, or we get out for a small debit on the short option, that's the easy part. What I want to go through with you is what's the hard part. Stock does go down to, say, 41 or 40, and we're still bullish. We believe in this stock. We like what they're doing. They're going to invent a better widget, whatever the case may be. We can then look into doing a 1x2 repair strategy, meaning we sell not one but two 45 calls, and with the premium that we collect on the 45 calls, we buy one 40 call. Now, that puts us in a position to where we're not taking on any additional margin risk because of the fact that one of those two short calls is covered by the stock, the other one by the 40 call. Typically, what we'll try and do is get it set up as a even money trade, meaning the two calls that we sold finance the one call that we bought. And then what we've created is the opportunity for potential double leverage if the stock goes higher. So then if the stock goes to 45 and we get called away at that stage, then it's as if it's at 50, and that makes for a really fun wheel when the stock can go down 10% and we can make a 10% profit and being bullish the whole time. Now, it doesn't happen like that all the time, but that's one of the tools with which we use.
Can I just mention one thing, and that was an excellent response, and that actually incorporated some of our other podcasts about the stock repair strategy, and that was some good stuff. The only thing I would differ with, not really differ with, is that we have a lot of customers that talk to me that actually employ the strategy. And I think I mentioned this on the last show. And they actually been, last year especially, very successful selling out of money puts. Finally, they get put the stock. Now what do? And what these customers have been doing is, let's say they've been selling the 100 puts for months. and all of a sudden the stock is now trading at 95, and they get put to stock. What these customers have been doing is then they'll go to the strike that they got put to, so the 100 calls, and they'll sell them for however long, and then hopefully the stock will probably back up to 100, and then guess what? You've collected a premium on selling the puts all these months and selling the only calls. But Mike made a great point. What happens in a not perfect world if now this SOX 95 goes to 90 or 85? And I think he gave you the answer. But if you want to just do the straight, income trade, that's where usually the customers that I deal with, they'll go back to sell the strike where they get put the stock.
All right, good stuff, John and Mike. I hope that answers your question, Dr. Anthony. A lot of great ways to use a wheel trade, but I think most people do fall into that category of writing a more near-term, a little more aggressive at-the-money type stuff because they want to collect and they want to roll on to the next phase of the wheel, if you will. All right, next up, a question from Nick Miner. He writes, how much money should I keep in my account for adjustments? This goes back to what we were just talking about, Uncle Mike. Does 10 to 15% seem reasonable in case I need to roll or trade stock against my options? John, maybe I'll have you go first because this is right up your wheelhouse, no pun intended from the last question, about margin and just kind of risk management in general. What do you typically counsel the clients over there at Sogo? How much should they keep open and flexible in their accounts for a rainy day, for when the adjustments come to town?
I think that I would keep more than that. I'm interested. I'm very curious to see what the other panelists say, but I think 10 to 15% for the rainy day fund. I don't think that's enough really, because you have to prepare for some outlier events and some other events. In other words, I'm basically a premium buyer, and I like to, for example, speculate buying premium, but I never risk all my money, all my eggs in one basket. I'm saying I'll keep 30, 40% just in there because I need to have that ammo in case I need to act. So I think the number should be higher, but I'm interested to see what the other panelists say.
So you're more like a 30% kind of guy.
Yeah, I would say 25 to 30% is probably the lowest that I would go.
Mr. Passarelli, what do you keep on hand for a rainy day in case the adjustment fairy comes to town?
You know what? I'm actually right exactly on the same page with John. And part of the answer to this question isn't just about adjustments. It's a question specifically about capital reserves, and needing capital for adjustments is one reason. But also, if you max out all your margin and you come across just a great trade, well, you can't put that on unless you close some other trade, and that's no way to trade. So, options are already very leveraged instruments. You don't have to max yourself out, man. 25 to 30%, I think, is just about right on the money.
Mr. Tusaw, bring us home. Where do you fall on the great capital reserve debate, sir?
In my most speculative account right now, and this is the absolute, by far, we are winging and we're running and gunning, whatever you want to call it. We have 78% of the account in a used for a combination of option debits and option requirements, and about 22% of it in cash on the sidelines ready to go. So this is the one that's probably by far, without a doubt, the most leverage that we have that I have under any of my management at all. So with it, a lot of times what I like to do is kind of commingle within the account. Like we'll have the more passive strategy combined with the more aggressive strategy, to where we'll have 10 to 20% of the big account in cash, but we'll have it set up of the speculative section. Probably 20 to 40% of the speculative section is probably in cash most of the time, and sometimes 100% of the spec section's in cash.
Well, there you have it, Mr. Miner. 3 takes, roughly similar. I'll throw my 2 cents in there, too. I tend to fall probably in that 25% or so range as well. So I think we're all pretty much in the same boat. Something we've counseled on the show in the past. You don't, just because you can do it in an account doesn't mean you should. People often think of the opportunity cost of having cash, or, well, I'm not putting that money to work. But what Dan said is also very true. You also are not able to act on other opportunities as they and could they arise down the road. And also, in general, you want to have some money for adjustments, and you want to have some money for the rainy day in case the worst comes to pass. You don't want to be out there just blowing out puts all day long and just maxing out. My account says I can do 74 of these, done, 74. That's usually a road to ruin, if not anything else. Keep a little bit in there. So maybe you do 50 instead of 74, and you save that balance for something else in case the worst does come to pass. And hey, maybe you need to buy a put on the downside to hedge a little bit or do some of the adjustments we're talking about here, or just in general have some good capital management. A lot of reasons you might want to keep that cash at hand. So in moral of the story there, Mr. Miner, 10 to 15%, probably a little low. Probably want to aim a little bit higher. I know that may be a little off-putting to some of you out there who like to really swing for the fences and sling. But if you're that kind of guy, you're probably not listening to this show anyway. So, all right, those are great questions. Again, a lot of great ways for you guys to write in and join us here on the Options Bootcamp Drill Instructor Squad. Unfortunately, that is all the time we have for the mail call segments. Also, all the time we have for this episode of Options Bootcamp. Before we go, let me check in really quickly with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Uncle Mike, what's cooking in the land of RCM Wealth Advisors?
Well, we're excited this Thursday night. We got that Passarelli guy coming to talk to us about protecting yourself in a down market. For more info on that, the webinar, go to rcmwealthadvisors.com/webinar. And then the following week, I will be speaking on the Iron Condor. So a lot going on for the end of February.
Still waiting for that big, stupid webinar. Let me know when that comes on.
One of these days, Mark, I'm gonna have you as a guest speaker. Even you get to pry apart my strategy. I'll let you do it.
I'll be the heckler out there in the audience saying, "Who wants to do these stupids?" And listeners, maybe we'll do an episode on stupid someday. Not a whole episode, but a portion, at least to explain to people what the heck we're talking about here, because it is indeed, listeners, a very, very stupid strategy, as the name implies. All right. Thank you for that, Uncle Mike. And Mr. Passarelli, what is cooking in the land of the elite, a.k.a. the MTM elite community?
Oh, man. There's always something cooking around here. Tonight, I have a webinar coming up in about a half hour, although it's kind of too late for you guys because we're recording this a few days ago. I have a webinar on falling markets, which, trying to encourage my students and my followers and our listeners to prepare for the worst, hope for the best and prepare for the worst. But, option traders can be pretty successful in down markets. So, thought it would be a good time to have a class on that.
Always a good time for a little market following, a little trend following edumacation. All right, sir. And last but not least, Mr. Critchley, tell us what's cooking, what's going on over there in the land known as SogoTrade.com. I know last time you were on the show, between gasps of bronchitis, you were able to let us know there's some cool stuff cooking over there at SogoTrade.com. So what's coming down the pike that our listeners can look forward to?
Yeah, I'm trying to get this VIP option hotline for our best customers open. So I'm working on that. So if you are one of our VIP customers, you can call me directly or one of my guys that I sit right next to. So that should be kind of fun for the customers. Maybe not so much fun for me, but if we get really busy. And we're trying to do a new program for new customers. Discounted commissions. If you're a big customer from somewhere else and you come over, we can talk to us and we can work on getting you some discounted rates. Give me some thresholds. That's kind of new here also. And we're going to be doing some webinars with the OCC in the next few months. So that should be fun. So good stuff coming.
So a VIP hotline. I like it. Pick up the red phone and call John when the market's melting down. I like it, sir. That is a very noble quest on your part. I got a feeling you're going to be getting a few calls.
Yeah, I mean, this might be the worst. I'm hoping it's a great idea, but it could be just, it has disaster spelled all over. But we'll see. We're going to get out to certain customers, and because they call me anyway. So a lot of these customers. So let's just formalize it, add some more customers, and see what happens.
Yeah, guys, and if you haven't checked it out, surf on over to SogoTrade.com and give John a call when he gets the hotline going. Tell him you heard him on Options Bootcamp and you want to pick his brain about whatever, adjustments or condors or whatever the case may be. Margin. Likes to talk about margin a lot on the show. So a lot of things to pick his brain on when that VIP hotline finally launches over there at SogoTrade.com. And, of course, on behalf of John and Dan and our special guest, Uncle Mike, and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program. Don't forget to download the mobile app, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.